podcast is brought to you by Schema Business School.
Hello everyone, welcome aboard in the seminar on globalization. Coming next, we are going to tackle the global capital competition. At any point in time, you have a fixed amount of global capital for which 185 countries, almost 200 countries in the world, compete. There's a race for attracting global capital flows. Now, there are a few myths and misconceptions I would like to tackle with you. The first one is that since the 1980s, financial globalization is forever. There is a wider and wider capital mobility worldwide. Well, in fact, not. Don't take it for granted. There are waves, ups and downs of capital mobility. If you look, for example, in the 1890s, where the British pound, was basically in charge of the global financial system, there was a very high capital mobility under the so-called gold standard. And then a sharp drop during, of course, World War I until World War II, and through the 1930s, the Great Depression. And capital mobility increased again since the Bretton Woods regime, 1945, until the eve of the global crisis in 2007, where we see a sharp decrease in capital flow mobility. This, in fact, is well illustrated in this graph. Capital flows, cross-border capital flows, rose from roughly $200 billion in the 1980s up to 1,200, 6 times higher in 2007, and then was sharply cut to around 200 again, 60% decrease in 2008. This volatility can also be looked at in terms of daily foreign exchange transactions. Every day, there are around $4,500 billion of foreign exchange transactions. But it's not a smooth increase. As you can see, it rose and declined at the time of the Asian crisis in 1998, again in 2000 at the time of the NTIC bubble, and of course at the time of the global subprime crisis in 2008. Financial depth, which is a ratio of financial assets to global GDP, is not a smooth ride. It goes up and down, depending, in fact, on cycles, crises, and volatility. And as you can see on the chart, financial depth globally today is around 400%. It means that financial assets globally are 4 times as large as global GDP. This financial volatility has a sharp impact on developing emerging markets. As you can see here, capital flows to emerging markets rose to around $1,200 billion, equivalent of 9% of these countries' GDP, very large impact, and then declined in 2008. Today, we are not yet back to the pre-crisis level, and all in all, capital flows to developing countries account for around $1,000 billion. The second misconception is that capital flows from rich to poor countries. And why? Because in fact, these poor countries have less capital and they offer higher returns for investors. And by borrowing from the global markets, developing countries can boost their investment and economic growth rates. That's not true. In fact, capital is flowing uphill from poor countries to rich countries. And which rich countries? First of all, the US, of course, which has very large current account and budget deficits. So where do capital flows come from? Well, let's look at the balance of payments of developed and developing countries. What do we see? Well, until the Asian crisis of 1998, developing countries had a deficit of current accounts. They live, if you will, beyond their means. And as of 1998, with tough adjustment programs imposed by the IMF, This country's balance of payments moved from deficit to surplus, up to $700 billion around 2006. In the meantime, the mirror image of this large surplus is deficit of the developed countries. In fact, the rich countries, as I said, live beyond their means. The shale gas revolution might change a little bit of this image, in fact. Those oil and gas importing countries, which will benefit from the shale gas revolution, Canada and the US, will of course now decrease their foreign dependence on oil imports, and that will alleviate the pressure on their balance of payments. Who will be the winners? Probably the US, Europe, China, Brazil. Who will be the losers? Middle East and probably Russia. These large surpluses of developing countries, lead to large increase in reserves. First of all, China, sitting on $3,500 billion of reserves. This leads us to the next misconception, namely, the rich developed countries with strong financial systems have large surplus savings. Hence, they export capital. Or in fact, no. The emerging market countries, with their dynamic growth, manage to boost savings relative to investment. Hence, a current account surplus. One of the best examples probably are Brazil, China, of course. And the best example of a steep increase in deficit is the US. The US current account deficit reached close to $850 billion in 2006. It decreased slightly yesterday, 2012, and today, 2013, not much due to boosting exports, but declining imports. If you take the deficit of the US, around $500 billion in 2013, it means that every day the US economy must import $1.4 billion. From whom? From the rest of the world. And who is the rest of the world? Basically, China. Looking at this graph, you can see that if you take global imports of capital, the US is the largest share. The US economy imports 37% of all capital flows in the world. Of course, at the expense of developing economies. Not much, for Central America, South Asia, or Africa. And the major exporter of capital are surplus countries such as China. There is Germany also, but most of the exporting countries of capital are developing countries. The accumulation of surplus in China's balance of payments leads to growing reserves. And China's reserves today are around $3,500 billion, close to 1/3 of the total reserves in the world today. Not only that, but these reserves, what can China do but investing in the US economy and purchasing the debt of the US, i.e. the US T-bills. And today, China holds 23% of the foreign debt of the US. Hence, not only financial power, but of course, geopolitical power. The next misconception is that the bulk of money going to developing countries to boost their wealth and growth stems from official creditors, the World Bank, the IMF, the African Bank of Development, and the rich countries, the so-called Paris Club. Well, in fact, no. The share of official loans and credits in developing countries is shrinking and small, not more than 6% of total flows. Private capital, FDI, foreign direct investment, bonds, bank loans today constitute the bulk of capital flows to developing countries. As you can see here, on the table, official inflows to developing countries, which means to 160 emerging market countries account for a very small share of total capital, around $30, $40 billion per year, peanuts. The next misconception is that all this external financing leads inevitably to large debt increases, to looming liquidity and solvency crises. Well, in fact, no. Foreign debt will lead or will not lead to a debt crisis, to liquidity and solvency difficulties, depending on the way the debt is invested, i.e. depending on the maturity of the loans and depending on the rate of return on the investment that is financed by debt. If we look at emerging market countries at large, well, there is a strong positive correlation between external financing, debt in fact, and GDP growth. Most of these countries, since the Asian crisis of 1998, have managed to invest more wisely their foreign debt. And why? Because most of the debt today is no longer coming from commercial banks, but from either bonds, long-term bonds, or foreign direct investment invested in the country's real economy. And this has managed, to decrease the solvency ratios of developing countries, debt to export ratio, which was very high in the 1998. It reached almost 200%. Today, this ratio has been cut to less than 25%, exactly 23%. Very manageable. And these large capital flows, FDI and bonds, have fed investment dynamics in developing countries, which on average is around 35%. Probably too high in the case of China. But too high only if savings are not following up. And in the case of many Asian countries and also Latin America, the countries have managed to keep in balance savings and investment. If you look at the investment and savings rates in Thailand until today, in fact, savings remain larger than investment, hence a current account surplus. The next misconception is that the bulk financing for developing countries, is FDI, foreign direct investment. It is a source of financing together with bonds. But although developing countries rely on FDI, the bulk of foreign investment stays within the rich countries, within the so-called OECD countries. FDI is investment coming from foreign source into the real economy of a country. It's a long-term investment. It can be new, so-called greenfield. It can be a partnership. It can also take the form of mergers and acquisitions, hence shrinking the competition in the home country. FDI will basically go to those countries which offer the largest promising scope for growth and return. Today, the so-called confidence index of A.T. Kearney gives in the top 3 positions 3 dynamic developing countries, namely China, India, and Brazil, 3 of the BRICS countries. These countries are targets of investment. The rate of return is supposed to be higher than in more mature, developed countries. Investors look at both sides of the equations, risk and return, the market potential. And the market potential in these countries is large due to large demographic expansion, larger and larger middle class, which means larger consumption prospects, and also probably declining financial risk. The middle class is a prime target of investors from the US, from Europe, from Japan. If we look at the next 30 years up to 2050, the bulk of the growing middle class in the world will come from a few countries, not Europe, not the US, not Japan, but India and China. Although, if we look closely at FDI, we're going to get a different picture. All in all, FDI in the world account for around $1,500 billion every year. And the lion's share, namely 56%, goes into developed countries, OECD, the Club of the Rich, and only 44% must be shared by 160 developing countries, of which Asia will get the lion's share, 53%, of which China will get 25%. So little remains, for Central America, for South Asia, and still less for Africa and for the Middle East. The next myth and misconception in this risky and volatile capital market is that investors can use rating agencies to assess, to measure, and to rank global risk. Well, no. In fact, rating agencies, such as S&P's, Moody's, Fitch, have missed the train almost in each and every crisis. They woke up too late in 1994 in Mexico, in 1998 in Asia, and of course, in 2006, 2007 in the case of the upcoming subprime crisis in the US. Three agencies have a de facto monopoly. S&P's, Moody's, and Fitch account for close to 95% of the market share of rating agencies. You have a number of smaller agencies, COFAS, and Dagong, the Chinese risk agency, emerging but still with a very small share of market. These rating agencies have been criticized for many pitfalls. As I said, they missed the crisis. They wake up too late. There is a socio-cultural bias because, in fact, they all belong to developed countries with an Anglo-Saxon culture. And they do not predict the spillover effect. In fact, they are very poor early warning signals. They failed to predict the 1998 crisis at a time when South Korea was rated as well as Italy and Sweden. They also kept providing highly risky securities with AAA ratings. And in a few hours, in 2007, they downgraded almost each and every of its mortgage securities, triggering contamination, contagion, triggering a spillover effect. And many countries which have large raw materials, oil resources, such as Cameroon, Gabon, Congo, Ivory Coast, and Russia, attract large capital flows, FDI, thanks to gas-driven revenues, gas-driven exports, and despite bad ratings. Russia is the archetype of a country which basically boiled down to gas investment and gas exports, despite very low governance and high corruption. Increasingly, investors, will not look much at S&P's, Moody's, and Fitch for investing in these risky and volatile countries. They will look at the broader picture, such as, what is provided by the World Bank, the so-called Doing Business Index, which will look not only at the macroeconomic picture, the financial system, but also governance and corruption. In that regard, the winners are no longer the BRICS. Brazil, Russia, India, China, South Africa lay behind a number of smaller countries with more promising long-term investment prospects. So all in all, how to assess the sustainability of capital flows? Well, we need a number of parameters. Of course, we need to look closely at the economic and financial risk. This can be done with a number of quantitative variables, number of parameters, ratios, numbers, projections. Number two, the wise investor should not lose sight of the socio-political framework, the institutional development, and structural reforms. All these parameters are not quantitative, they are qualitative. And finally, the investor must also look at the resilience to crises. Is economic growth in country X leading to sustainable development? And this means that development, stems from economic growth, plus all those conditions that make it sustainable. including health, education, and the political system. Thank you.